Welcome to Lithium-ion Rocks, Season 2, Season Premiere. I'm here with Rodney, and we have two guests today. One is Reg Spencer, a leading analyst covering lithium space for years at Canaccord Genuity. We also have Will Adams from Fastmarkets. Fastmarkets has their inaugural battery conference in Amsterdam in late September, and there's also a nickel conference that they're sponsoring in Jakarta in early September. Canaccord hosted 2 weeks ago a major conference in Boston called The Future of Transport. Lithium Americas, Piedmont Lithium, Critical Elements, Neo-Lithium, I understand a Standard Lithium, and Critical Elements and Nemaska were there as well. Meanwhile, Diggers and Dealers was the show. Pilbara was down there, gave an interview on CNBC, but Reg Spencer was there and basically said that gold is hot, but lithium is cold. But first, we want to flag for everyone something new. There's now an opportunity for all of you to contribute to Lithium-ion Rocks through the Patreon platform. And here's a little advertisement that we put together to launch it. Welcome to Lithium-ion Rocks Patreon advertisement.
I think it has great potential.
That's 5 to 7 times GDP.
Hi, my name is Rodney Hooper, and I am co-host of the podcast Lithium-ion Rocks. My podcast co-host, Howard Klein, and I have spent many hours discussing the industry with CEOs, industry participants, traders, and all forms of users along the battery supply chain.
Rodney and I started Lithium-ion Rocks to broaden the reach of our research into the most exciting producers and aspiring producers of lithium and other new energy materials fueling these batteries. I've been an investor, analyst, and capital markets advisor for natural resource equities for over 18 years, including some of the most prominent lithium battery materials development successes. A massive disruption is underway in transportation and utilities, fueled by lithium-ion battery technology. Rodney and I have joined the Patreon platform to deepen our engagement with our listeners, as well as to help defray travel and other costs associated with producing lithium-ion rocks.
Howard and I would like to attend additional conferences, do on-site field visits and site visits to upstream and downstream assets, and deliver that information to our listeners.
Rodney and I maintain a proprietary supply and demand and pricing model, updated quarterly.
For those that are happy to support us on Patreon, we would look to share our proprietary supply and demand models and give regular updates on those. We are all keen on lithium, and we'd like to share more. Thank you for listening.
As an additional incentive to subscribe to the Patreon platform and be in at least our second $10 tier, we will be providing some exclusive content and previews. So Rodney and I spoke about Albemarle and Livent offline, which is not part of this podcast, but will be in an upcoming podcast that will also include SQM's commentary after their conference call this week. But if you want a preview on that Albemarle Livent, please subscribe to our Patreon site at the $10 level per month at least, and you'll have access to this and all future exclusive previews. And with that, we will begin the first episode of Season 2. Despite the fact that it is today the 50th anniversary of Woodstock concert, two very significant concerts took place in New York over the summer while we were on break. One was the Rolling Stones, the other was Queen. So I just gave you some reference to We Will Rock You, We Are the Champions. I had a great opportunity to reconnect with the Stones, and there were so many narratives and so many songs. And we begin with Will Adams, who Fastmarkets has been particularly bearish all year, and they've been right. We had him on the show in Santiago. Hello, Darkness, My Old Friend. And today, Do, Heartbreaker. Pretty much sums up lithium.
It's good to have you again, Will. Just looking at the markets out there, we've seen some big movements on the cobalt front from Glencore that's done good things for the price, but the same can't be said of Albemarle's proposed cutbacks and expansions. Why don't you give us some feedback on the pricing sheet that you put out?
We continue to see weaker prices on spot prices, and we think that is basically down to an oversupply situation, and it also hasn't been helped by probably weaker than expected demand as well. For the first time, I think in July, we saw Chinese NEV sales fall year on year. I think their production was down 6.9%, with sales down 4.7%. So that's a bit of a worry sign on the demand side, even though we think that will be fairly temporary. But as you said, the Albemarle announcements, I think most of that is going to affect the market much further out, and therefore that's not it's a sign of some sort of supply restraint, but not at the moment, not near term. So I think at the moment, as I said, oversupply, and we're seeing sort of prices come under downward pressure as a result of that.
Livent and Albemarle are saying non-integrated converters can't be making a margin at these prices. So the only give is spodumene concentrate, and they really don't have much give. So how much lower can we really go?
Yeah, that's a good point. And I think, where there is sort of margin along the supply chain, especially upstream, I think then, the converters will probably, in order for them to be able to continue to buy spodumene, then they will need to get lower prices from their suppliers. So where there is margin and producers might be in that uncomfortable position of either having to say, well, we will lower our prices, or they will go somewhere else maybe. So I think there is still room on the downside. We're certainly forecasting prices to remain under pressure. We think the fall will start to slow, but we do still see prices coming down further at the moment.
And what would that translate into then in implied spodumene concentrate prices?
Yeah, 585, 650. So at the moment. I think we will start to see some of those spodumene prices head lower. I think it's going to happen in a step down process. Although the margins might be tight, I think the margins will get tighter. Converters will then continue to produce, and therefore that will also probably end up pushing prices down. The rate of price fall will start to slow down now and flatten out. It would be good to see a rebound in demand. We do expect to see some sort of pickup in EV demand into the fourth quarter, which is fairly seasonal. And I think after the subsidy changes we saw earlier on in the year, plus with the fallout from the trade dispute and the general economic weakness, those two factors are having an effect. I think the subsidy thing we will move through and move past, and that will sort of start to see demand pick up again. And if we were to see a new trade agreement, then I think that would be significant for global growth generally, and I think we'd also see households and businesses start to build up their confidence again, and we'd start to see sort of more spending on some of these large ticket items such as vehicles. But we've waited a long time. It's been going for over a year now. I think the impact, the fallout from the trade dispute. At some stage, I think when it does come, when we do get a new agreement, I think we would be in for a general pickup in demand and that I think to some extent will feed through to prices. But for lithium itself, the overall oversupply is probably it might put a cap on prices, so we might see prices level out, but we don't expect too much on the upside anytime soon.
And what about things like, Tesla about to launch the Model 3 in China and possibly the Model Y, etc., and Europe going from 60 EV models to 214 by 2021? Do you think that will help counter, a general slowdown or the subsidy changes?
We're bullish on demand. And I think we have hit a bit of a weak spot, as I've sort of mentioned, and that was probably it's been it's been weaker than we expected it would be. But I think overall, there's the demand's only going one way, and I think as we get more EVs, there'll be more choice. As prices come down, we'll see strong EV uptake, and that doesn't change. And I think we're going to see that for decades, not just years. I think right at the moment, I think we're just in a situation because we saw a lot of new supply coming on last year, and we're in a situation now where we are in an oversupply situation because of that new supply, and as a result of that, we now have to wait for demand to pick up or to catch up, not to pick up, but to catch up. And I think it's just a matter of time, and we might see in this sort of low price environment, we might see more supply restraint as well, which would then also speed up that sort of the time when we start to move towards a sort of supply deficit again.
You were talking about lithium, that one of your themes being that commodity markets can be ruthless, and the lithium specialty chemicals market is showing all of the signs of being a commodity. Could you share with us and our audience, I guess, your background? I think you came to lithium a bit later, as price forecaster, et cetera, but have been covering many other markets and bring that level of experience to the lithium forecasting commentary. Your background and what you've learned from that to make you analyze lithium as a commodity.
Well, I've been a sort of a commodity analyst since 1986, so you can do the maths on that, and covering precious metals and base metals, mainly base metals, up until moving over into sort of lithium and cobalt and nickel. So yeah, and I've won a lot of experience on supply and demand analysis and forecasting, but also in commodities general and how they operate, but also in places like China. So it's one thing I have learned is China is very adept at bringing on things fast and often bringing on too much supply as well. But I think one of the things I have said over the last few years in the sort of the lithium space is don't underestimate the Chinese and their ability to get the know-how and to catch up. And I think we are in that situation now on the supply side with their ability to produce sort of battery grade materials from various different materials, and they have their sort of conversion plants as well. So I think the fact that's one side of the supply side. So you've had the increase of obviously the Australian miners and producing spodumene, and I think the Chinese now are being able to produce battery grade material from that. And I think it's interesting that you've seen exports from South America into China falling, but exports from China picking up. So I think that's a sign that they have been able to increase their production as well. And I think the more we see of that, the fact we've got more producers now in the market than we had a few years ago. I think that is another factor. There's more supply around, more producers, more competition. That's another factor which sort of makes lithium more of a commodity. I still understand it is a specialty chemical, and I totally understand that, but it does show more commodity attributes at the moment. And I think the fact we have seen a pickup in supply last year, and not surprisingly, we've seen prices come under downward pressure. And I think we're now in a situation where prices will remain under pressure until we sort of see more supply restraint.
Into the spodumene concentrate, guys, some of them are talking about getting new offtake partners that aren't based in China.
I think what you will see is some OEMs, more OEMs, getting arranging offtake deals with producers, and they'll either be in Europe or in the States as well. So I think there will be that type of sort of divergence, and I think some talks are underway on things like that. So yes, I think there will be more.
Now that Livent and Albemarle have reported, we're only really awaiting SQM. All the ASX quarterlies kind of came out a few weeks ago. Rodney wrote about 5 of the spodumene producers. We're going to talk a little bit about that and exchange thoughts, with Reg.
Benchmark wrote a publication recently in terms of all of the conversion capacity in China and when it was meant to come online and where it's at now. We seem to be way behind there in terms of conversion capacity.
The lithium industry has a very poor track record of meeting expectations when it comes to delivering new supply and delivering new ramp-ups. Now China is a slightly different case where a lot of the smaller converters outside of the Tier 1 and Tier 2 arguably are suffering from lack of liquidity and lack of capital. If the lithium price in China was at $20,000 a tonne, there's no shortage of capital available to fund new converter plants. But when China or a small converter plant is currently marginal, that capital is not available anymore. You've had prices come back from $20,000 a tonne to 10. So the incentive for capital to flow into that industry is not there as it was 2 years ago. Now, compounding that, the Tier 1 producers like a Ganfeng, a Tianqi, and even some of the smaller guys like a General Lithium, a Yahua, those ramp-ups are taking longer than planned, but also they're not generating as much margin and cash flow from their existing chemical sales to fund new plants. So, it all becomes a bit of a domino effect. And then in turn, that puts pressure on the spodumene market, who for the last 2 years have been told nothing but rising demand and converter capacity is going to be there. We're going to need your stage 2 and your stage 3 expansions, and that's going to drive the way and the behaviour that the spodumene guys do. So it's all kind of unwinding. Now, we were always cognizant of the fact that effective capacity is certainly not the same as installed capacity. And look, there's been a lot of commentary by many people on this topic, but you only have to go back to 2018 and effective capacity in hard rock converters was still only running at about 65% on average. I think now the market is now coming to grips with this reality, but not before we've seen some significant expansions in concentrate output. So I think that could lead to some pain with the concentrate guys. There is still some inventories that we got to work through, and you saw that after the recent reporting period, just between Galaxy, Pilbara, Altura, and Alita. You've got 150,000 tonnes of concentrate just sitting in stockpiles either at the mine or at the port, and that excludes any.
I've commented on that as you've had all the cash from the balance sheet convert into working capital.
Exactly. But, as you've seen, Alita is in a trading halt. They announced a number of weeks ago that they're undertaking a strategic review. Now, normally in my universe, strategic review has negative connotations, whereas what Alita announced was actually more an operational review, which included many aspects of the operation, deferring the expansion, but also seeing if they weren't able to rework one or two of their existing offtake contracts. In terms of Altura, some initial commissioning issues look like they've been worked through, and the operation seems to be running really well. It's pleasing to see a company with their costs that low, at sub $400 a tonne, because that puts them in the ballpark of what their feasibility study estimates are, and arguably that makes them the first company to be able to do that. I think the real challenge for Altura is less around operations and more around balance sheet. They have $140 million of debt that matures in about 12 months' time. So if you're a financier to Altura today and they can't refinance those notes, and instead of taking ownership of the asset, you could be, it could be quite an expensive piece of money.
Reg, they've done very well in terms of getting new buyers on the books and keeping their inventories in check.
Yes, they have, and I think this could come down to their product quality. The fact that they were able to attract the Ganfeng for not immaterial volumes speaks for their product quality, and this flows back to their process design, which is different than what Pilbara had put in place. You must applaud them for their efforts on marketing, but they had to. They had some issues with JRO. They had some issues with Linergy, and obviously they're looking at up-tiering the quality of their offtake partners, which hopefully in time should allow them to refinance that debt. But right now, the balance sheet is probably arguably the largest overhang on that company in terms of an equity investment perspective.
I agree with that, and it's a question of how long this low price pain will endure. And Shanshan, what do you make of that? I mean, that's a pretty significant investment, both new equity and the purchase on market.
Yeah, it was an interesting arrangement. Our understanding was that Shanshan were owed money by J&R Optimum, and so the equity that they have taken was arguably in exchange for closing out some of those loans. What was more interesting is that further strategic partnership there with Shanshan being a cathode and anode producer but have no conversion capacity. But that gives them the ability to put their foot on that product and control where it goes, and might see them actually look to toll treat some of that. So, look, Altura have arguably been the most active on the marketing front and have delivered some high-quality names to their offtake book, and they've arguably got a more stable group on their share register in Shanshan versus JRO.
Well, that's for sure. What do you think about Pilbara and their ramp up vis-a-vis Altura? And what do you foresee in Pilbara in the next couple of quarters?
I think that the ramp up should proceed. Obviously they've been a little bit slower than an Altura. They've had some initial, let's call them teething issues with production volumes. And from what I understand, they've had some issues with product spec. And that's revolved a little bit about with the iron content of the concentrate and also the moisture. But look, these aren't critical issues. They're not insurmountable, and expect to see them work through over the next little while. In fact, Pilbara were expected to complete an upgrade of their filtration circuit this quarter, for example. And if you are having iron contamination in your concentrate, it basically can be resolved through the installation of a few magnets. So, some of the issues that Pilbara have had, I don't expect to be terminal or critical by any stretch. I think the biggest thing facing Pilbara today is where they stand on their planned expansions. Do they still do a stage 2 on the timeline that they've currently suggested? Will they get a bid at the end of their official process, which finishes this quarter? I'm a little less circumspect that they will get a bid at the end of this process, which would arguably allow them to fund stage 2 and move downstream.
I'm sorry, you said you are less circumspect or more circumspect? I mean, do you think it'll happen?
More. I think it's unlikely, but it all comes down to price. They may get bids, but are those bids of a sufficient price that supports Pilbara's own view of what their asset is worth over the medium to longer term? Remember that they're only selling between 20 to 49% of the project, and if you're a buyer, what are you actually bidding for? Noting that the offtake rights to both stage 1 and stage 2 have already been sold. So you're buying somewhere between 20 to 49% of the mine, and you're buying rights to stage 3 offtake, and you're buying rights to capital costs for a potential converter plant. I just don't think there are any groups out there in the market that would be willing to pay a big value for that today.
So the value in Wodgina was that everything was available in comparison.
Exactly, and the value at Kidman was that everything was available.
What do you think the probabilities of Pilbara reaching the low 300s as a cash cost by Q4?
What they've delivered to date suggests that probability is low. Let's see how they go as they ramp up volumes. I was circumspect that Altura could have delivered costs to that level as well, but they seem to have. or at least they're certainly heading in the right direction. There will be some material improvements obviously needed for Pilbara to get to that level, but I guess we'll have to wait and see. The best way to play lithium, arguably, in the Australian small cap space has been through two companies that aren't in production yet, Lithium Power and Piedmont. With Piedmont, I think most people are attracted to that story on the basis that it's looking to be an integrated hard rock. It couldn't be better located there in southeast US. I visited the project year before last and was amazed by the logistical benefits and the sheer beauty of being where they are relative to the normal remote projects that I'm used to here in Australia. And they seem to be delivering on the resource upgrades, and that resource will get bigger in time. So, Piedmont is certainly delivering on their project milestones, and the integrated nature of that hard rock should see them mostly avoid the indigestion that we're currently seeing in the concentrates market. And look, the strategic value of that asset, I think, will become more prevalent, or the perception of the strategic value of that asset will become more prevalent and over the next little while. I'm sure you guys have spoken a lot about the US's strategy around securing critical minerals, and this feeds right into that. So, no, we like Piedmont and we like their chances for success.
And what about Lithium Power?
I've been attracted for lithium power for some time. Chile is a far more stable jurisdiction than Argentina. We've obviously seen what happened over the weekend. The Argentinian stock market was down 35% one day yesterday. And while that may not necessarily directly impact some of the brine guys in Argentina, the perception of instability will be enough to give share prices or drive volatility in those share prices. Notwithstanding, you've got the impact on currencies and local operating costs and 55% inflation. So I've always liked Chile from that perspective. It is far more stable, but also LPI's asset in Maricunga, it is a high-quality brine project. Unlike a lot of the ones in Argentina, it's got access to infrastructure. You've got roads, you've got power. They have secured water rights already. Notwithstanding that, the chemistry of the deposit is very good, very, very high lithium grades, which is almost double what you see on average in Argentina. Now, that Codelco deal, even though what they've announced to the market still begs a lot of questions. What is the ultimate ownership of the joint venture? Who's going to be contributing what? But there are some very material benefits that will flow from that joint venture, notwithstanding that the combined entity will have all the permits that they need. LPI have their export license, which is the CSHN. They've completed the EIA. They've got a definitive feasibility study that's completed, whereas Codelco bring in the CO, which is effectively the production permit. So you now got an entity pro forma that has all the necessary permits to develop the project. But Codelco also brings a balance sheet. It also brings additional tenure, which you could argue will bring additional resources into the pro forma, which gives you the potential to upscale from 20,000 tonnes, or gives you a longer mine life. So there are multiple benefits that are going to flow from this partnership, and I think these are now being reflected in the share price, which has gone from 20 cents a few months ago to be trading at 45. There aren't many lithium companies on the planet that have doubled their share price in the last 6 months. So it's a very material milestone for Lithium Power, and it does put them in good stead ahead of an FID and potential financing and offtake discussions, which we think might start in early 2020. On a medium to longer term view, Orocobre is one of our top picks in the sector. And in an environment where margins are contracting and balance sheets are becoming issues and previously mooted expansion plans are being curtailed, Orocobre is actually well placed, despite their well publicised ramp up issues, despite their well publicised product specification and product quality issues, Orocobre still makes money. And this goes back to, one of your investing 101 points when it comes to commodities is you have to be at the bottom left of the cost curve, and that's firmly where Orocobre sits. They have a very healthy balance sheet. They are diversifying into hydroxide through Naraha in Japan. They've got a stage 2 that's coming online. They've got a better understanding as to how to work through the climate difficulties that they have. And I think their stage 2 expansion plans should see them avoid most of the issues they had during their stage 1 ramp up. So on a medium to longer term view, Orocobre is well placed. I just think in the shorter term, this political instability and economic instability in Argentina is going to impact investor sentiment. So anyone looking to take a longer term bet on Orocobre might be disheartened a little bit or be made a little nervous around what's going on in Argentina. You're moving away from a pro-business government back to potentially a socialist-style government. And over the Kirchner years in Argentina, that didn't really work out so well. So it'll be very interesting to see how Orocobre trades today and over the next little while leading up to the election in October.
What would the impact be if the China EV subsidies are fully withdrawn next year?
We noted in our research in April that the complete withdrawal of subsidies could lead to some volatility in sales, and our modelling is looking at basically only around 1.5 million unit sales in China this year. So that rate of change in terms of growth was starting to slow based on that uncertainty around the subsidies. There is no doubt there is going to be an impact on China unit sales on the basis of the lower subsidies, but it's important to remember that the Chinese are very, very keen to ensure this happens. And what you might see is a change from their approach. Instead of offering subsidies to the buyer of EVs, that funding might go into other parts of the EV supply chain in order to encourage increased adoption. And what you might see is increased charging infrastructure, for example, or increased rollout in more rural areas away from your heavily populated centres in Beijing and Shanghai. It's really difficult to quantify at this stage. What we do know is that typically unit sales throughout the course of a year tend to be stronger in China in Q4 relative to Q1. But that's only because of the step change or the step down in Chinese subsidies that were in place previously. You can easily chart quarter-on-quarter unit sales in China and the spike in sales in Q4 before those subsidies stepped down in Q1 of the subsequent year. So if those subsidies are removed altogether, are we going to see certainly some volatility, or is it more of a case that the adoption rate would just slows a little bit? Noting that the adoption rate has been very rapid over the last couple of years in China.
I mean, you still have the NEV policy overall, so there is still some requirements, in terms of sales. But I'm just wondering if that removal in subsidies would then also have a roll-on impact on battery size.
Well, we know that it's having an impact on the chemistry of the batteries and battery size. If you go back and have a look at the subsidies, one of the qualifying factors is driving range. And the two things that give you an all-electric driving range is your energy density and your battery size. And I know you guys have talked about this shift away from your LFP towards your higher energy density batteries like your NCMs and your NCAs. But as I said, the battery size is going to play an important part of that. So, yes, maybe we do see larger batteries as opposed to larger volumes of cars with smaller batteries.
If you look at what's happening, not with what companies are disclosing for their cash costs, and this is a spodumene concentrate producers, but if you look at their cash balances as they move from quarter to quarter and their inventories, where do you see the bottom for spodumene concentrate 6% prices?
Our current forecasts are low 600s, but already we've probably fallen through that. So our forecast might need some reworking. I think we should be thinking about spodumene with a 5 handle into 2020 and perhaps even 2021 until these inventories are worked through. And lithium chemical prices in China rise, which give the converters the margin, and then that margin then flows upstream to the spodumene guys. Now, a lot of the cash costs that these spodumene producers have reported in that last round of quarterlies are a little bit misleading. They've reported costs of production, not your cost of goods sold. So if you have a look at the cost of goods sold for Alita, for Galaxy, for Pilbara, they actually lost money last quarter. While production costs coming down is a good milestone for a lot of these guys, they need to be able to sell that stuff at the same time.
100%.
So I think we should be thinking about spodumene prices with a 5 handle moving into next year. Again, we still need to see not an insignificant amount of inventory work through, and at the same time converter capacity ramp up before we see spodumene prices rising to back to anywhere near the previous levels.
Well, you can lean on Rodney and me now for a bit of banter. That song was Let It Bleed. Rodney wrote and I collaborated on something called Wait in Vain, Jamaica Me Crazy. Would encourage you to read the last Lithium-ion bull, which included a extensive section on Rodney covering, the 5 spodumene producers, Alita, Pilbara, Altura, Mineral Resources, and Galaxy.
As we know, Alita raised capital from its anchor shareholders, including Galaxy. What has transpired from there is that they have effectively taken that cash and converted it into working capital because they haven't managed to sell what they are producing. Their cost of production is still a little high because they're still relatively high in strip ratio as they continue to expand. So unfortunately, they found themselves in a position where, I did the math. This quarter, they needed to sell about 45,000 tons of production in order to avoid breaching the debt covenant with Tribeca. So they have, they also have the issue of their offtake partner, Ajanti. They have a 680 floor, which, given where chemical prices are in China, that's probably going to put them in a bit of a pickle. So they find themselves in a position where they need to sell more of their product. I stand by my previous positive thoughts on Alita. I think that they have the potential to drill out a meaningful resource, a long life resource. The quality of the product is not up for debate. It's a decent spodumene concentrate. I think if someone were to set up a plant with that spec in mind, that they would have, assuming they have some reasonable expertise, they should have a good probability of producing battery grade out of that material. So they just need to re-engineer the balance sheet a bit. They're not alone. It's just that they are the highest cost producer at the moment and likely in the future. And, they just have sold way below what they're producing and find themselves in a bit of a squeeze.
Yeah, debt is a problem. The market has shifted so fast, from high prices to low prices, and a project like Bald Hill, which had the first year high strip ratio, higher cost before you get into the lower cost, you just get caught out by the very fast decline in demand. At the same time, a lot of spodumene supply came online. So I believe, I think as you do, that the Bald Hill ore will become a fixture for a long time to come in the in the lithium chemical supply chain, as will Pilgangora's ore. But as an equity holder, when you have secured debt at a high price, this is the pain that you suffer when the market moves, in the wrong way at the time that you are ramping up and you're not yet at full capacity. Roskill's Jake Frazier wrote a nice note about this as well on LinkedIn. I'd encourage anybody to listen or to read that as well. Democracy in Hong Kong has been a very significant political issue. And Argentina, if I just look at Ganfeng, Hong Kong and Argentina has not been a great, week. But in particular, they needed to execute a Hong Kong rights offer because they were executing a Shenzhen convert, which the underlying, equity would have meant that the Hong Kong listing would have, had less than 15% free float. And there's a rule that, the Hong Kong has to be at least 15%. And, they had an EGM and they got the votes for everything but the Hong Kong listing. They needed 67% vote or 66, two-thirds vote. They only got 65%. I tweeted about this. Their cornerstone IPO shareholders included Samsung and LG Chem and 4 state-owned, Chinese, car companies or other ways tied to the, this industry. So I doubt those guys voted no. I know Oaktree was one of the filing shareholders as a hedge fund, and maybe a few other hedge funds were in there. I'm presuming they voted no, but it's a real question. Is this financing somehow delayed? Or what are they going to do? They can't go ahead with the Shenzhen if.
I'm not sure how long corporate filings. I know here, South Africa, I think it's like 21 business days or what have you. They could speak to shareholders and then refile to do the vote. And it was interesting that the Shenzhen shareholders waved it through. It was just Hong Kong.
Yeah.
So it seems,
it
seems the protest has come from the streets into the boardroom, but
I'm a shareholder in Ganfeng, and I hold my account at Interactive Brokers, and I was never sent a proxy in the way that, like, for my Australian shares, for Alita, if I needed to vote, I could have voted. I was not given an opportunity to vote from Ganfeng, and I wonder how many other shareholders, are like that. So I'm majorly disappointed, in Ganfeng since the IPO in terms of their communication with investors. I mean, here we are, we're talking about, what did Livent say? What did Luke Kissam say? And, the sound of silence, Ganfeng basically only talks, through their filings, and they make a lot of news, right? The back in Nora, was another deal, but the use of proceeds, they were trying to raise $450 million, $350 million through the convert, $100 million through the rights offer, and the convert money was very significantly for Lithium Americas, Minera XR, as well as working capital to buy spodumene. So to the extent that there's any delay in closing this transaction, it could be a negative for Bacanora, it could be a negative for LAC, it could be a negative for Altura and Pilbara, who are their offtake partners and have been slow buying from them. And I think their most, the mineral resources, Mount Marion, would be the last thing that they would cut. Question mark, around that, and also question mark continued with the trade war, and also I just hope that things don't get worse, with these Hong Kong protests. But a lot to follow up on here. There's a lot of stories and unanswered questions. You mentioned, just going back to Livent. Livent is predicting 140,000 tons this year of hydroxide supply, which is crazy higher than anybody is forecasting, and and runs counter to this narrative. We referenced, Andy Miller's benchmark with all of these tier 2 and tier 3 converters that are kind of in construction but not yet in production. and all talking about the Pilbara, the conversion bottleneck. Here we're hearing Livent saying there's actually 140,000 tons of essentially battery grade hydroxide that they're competing against. Where's that coming from? Is that Shanghai brine, converted by some of the same guys that clean up, Orocobres? I don't have an answer to that question. I know you don't either, but it's one that I'm looking into in the next kind of couple of weeks and months, as well as these questions on Ganfeng and Albemarle. So with that, I think we will conclude, Rodney, this first episode of our second season. It's been great working with you since the beginning of the year. I'll remind all listeners we are on Patreon, so please visit the Patreon website. That's Patreon, and type in Lithium-ion rocks and get out your credit card or your PayPal or your Venmo or whatever and start, contributing $1, $5, $25, $50, or $100 a month to ensure that this lithium equity intelligence continues to come your way. Lithium-ion rocks, Lithium-ion bull, and through our respective LinkedIn and Twitter posts, Rodney and I may share with our audience some rationale for a stock for which we have conviction, to own or not to own. If you agree or disagree with and act on or against the rationale of anything said or written in this or any other lithium-ion rocks or lithium-ion bull, that's your free choice. But to be clear, what you are listening to or reading is not investment advice and may not be unbiased. It should not be construed as an investment recommendation to buy or sell any security. Rodney and I are not registered investment advisors nor broker-dealers. Please visit libull.com for further disclaimers.